Clicked onto Three Guys in an iPad, the virtual water cooler of the mortgage industry. And I'm Brian Rieger. I'm one of those aforementioned three guys. I am, of course, the principal of True Impact Communications and co-founder of Content Beacon, the producer of this podcast. And we wouldn't be three guys without Rick Grant, co-founder of Content Beacon and the owner of RGA PR. Rick, how are you today, sir?
Doing good, Brian. It's good to see you as always. Really excited about today's show. Good job lining this up.
We've got a good one today, and I think we've got a lot of different nuances to cover. So with that, let's greet our third guy, but first in our hearts, Mr. Kevin Breeland of Amplify Credit Union in Austin. Kevin, you are perched on the river as always down in Austin. How are you today?
I'm doing well, Brian. Thank you for asking.
Absolutely. It's great to have you. And this is the point of our podcast where I make our shameless plug for the producer, Content Beacon, the leading B2B content marketing agency in the mortgage industry. Now, if you would like to ask us about Content Beacon, or you'd like to be a guest on the show, or there's a topic or a guest you'd like to see, please take a look at the show notes, and you can reach us at brian@contentbeacon.com or rick@contentbeacon.com. Now, today we're going to be talking about something of quite a bit of interest to a number of folks in the mortgage industry. That, of course, will be the Payroll Protection Program, PPP. And if nothing else, I'm hoping that our experts will be able to teach me a better acronym or a better way of referring to it in shorthand. This should be a good one. If you're lending in the Payroll Protection Program, or if you're a small business borrower, this is the podcast for you. So without further ado, I'd like to introduce our special guests. Our first special guest is a former federal prosecutor. He's currently a partner in the white collar and government litigation practice at Saul Ewing, Arnstein and Lair. He's certified by the Society for Corporate Compliance and Ethics as a certified compliance and ethics professional. And he defends both individuals and companies in all kinds of government investigations, as well as private litigation involving whistleblowers under the False Claims Act. Welcome to the show, Justin Justin, help me out again. I'm sorry.
Danilewitz, Brian. I don't take it personally. Happens all the time.
I do apologize. And,
great to be here.
We love having you here. And you're coming to us from Philadelphia today, correct, Justin?
That is right. Great to be with you all. Thank you so much.
Outstanding. And our second special guest has over 20 years of leadership experience with well-established banks and trusts. He's a highly regarded financial expert with a strong history of guiding company mergers, launching or restructuring credit departments, and overseeing local or national teams. Welcome to the show for Alan Jules, EVP and Chief Credit Officer at Amplify Credit Union. Alan, welcome.
Thank you. Welcome to be here.
It's great to have you. And our final special guest is also a partner with Saul Ewing, Arnstein and Lair. He's in the Pittsburgh office. He's been a federal counterterrorism analyst and a certified anti-money laundering specialist. He now practices law, having spent over a decade advising Fortune 500 financial institutions, regional banks, credit unions, and individual executives on numerous issues, including anti-fraud, BSA, AML, CFT, consumer protection, cybersecurity, and suspicious activity reporting regulations. Welcome to Three Guys, Joe Valenti of Saul Ewing.
Hi, Brian. Thanks for having me.
Great to have you today. And easy for me to say, guys. Let's let you do the talking from this point on, as you are our experts. We're going to jump right in. I'm going to toss out a question to the round table. Alan, maybe you'd like to take the lead. Give us a start. What exactly is the PPP program?
Well, in a nutshell, the government tried to roll out a program that was very much centered around the energy and the spirit of the SBA. The Small Business Administration, the SBA, is one of the arms or government verticals that helps facilitate lending throughout the entire country for small business owners. And within the spirit of the SBA program, they tried to roll out a program that was as simplistic as possible so that the lenders were able to get money in the hands of ultimately the consumers, the employees, filtered down through the businesses as easily as they could. And one of the things about the entrepreneurial spirit in the United States is entrepreneurs are probably the most creative, the most tenacious, the most resilient, born to survive individuals on the planet. And I mean, they'll eat peanut butter and jelly and macaroni and cheese and work 16 hours a day to make their business survive. And so the program in many ways was kind of, for us lenders, it was kind of bittersweet. It was really a sweet opportunity for us to be able to help and cater to our business members and clients. But at the same time, it was a little bit bitter because the chaos early on in the process was really challenging for us, as well as for the business owners and their employees. But I think at the end of the day, as they've made multiple changes over the last couple months, the SBA has provided a product that really delivered and ultimately did serve all the business owners and the needs that they really had. So that's kind of it in a nutshell.
Well, and it's of course a moving target, as we'll discuss, and it's an ever-evolving program as well, Alan. And I'm going to turn to Joe here for a moment. Joe, what are some of the primary expectations that have been set for PPP lenders by the SBA or by the federal government in general?
The government made it clear at the outset that they wanted to get money distributed quickly, and they created a significant safe harbor for lenders. This is unusual even for an SBA program. Full reliance on borrower certifications of need is expected, and that's fine for lenders to follow. They wanted them to get the money out quickly with very minimal red tape bureaucracy. As the program moved to the forgiveness stage, there's a little bit more documentation needed, but it's still a business-driven program that the politicians are trying to get out of the way and let it run smoothly, and they've adapted. It was still clear at the outset, and even more so through present day, that there will be fraudsters that try to get loans inappropriately, and lenders have to be on the lookout for that. And the government's already brought some prosecutions against those fraudulent borrowers. Lenders always have their existing Bank Secrecy Act, anti-money laundering, combating the finance of terrorism, and other anti-fraud and consumer protection laws to follow. Those aren't waived here. There's still an expectation that you not lend to criminal enterprises, that you report suspicious activity, that you know your customer, that you not discriminate in lending, that you provide equal opportunities to businesses, and recognize that the existing compliance framework still does apply. But this was very much a program that was not meant to get hung up on minor details or a missing document or other bureaucratic hiccups. If somebody needs the money, get them the money. If they're a criminal or a fraudster, don't give them money and report them. The government's kept it very simple, almost in that stark of a contrast.
Okay, so we've got the federal government trying to get a lot of money out there really fast, and they're trying to do it through banks. Okay, the plot thickens. Justin, what kind of oversight is there for the CARES Act and the PPP program specifically? We've got expectations. Who's keeping an eye on the flock?
Sure, good question, Brian. I mean, the way you just put it is perfect. What could possibly go wrong? You're injecting $2 trillion into the economy, right? People who are desperate for financial assistance and a lifeline for their businesses. They want to keep their employees employed. They want to keep checks going out to them. And we're in the midst of, the biggest economic crisis since the Great Depression. There is somewhat of a perfect storm that all of these factors creates. And so unsurprisingly, there are a number of oversight mechanisms that were established in the CARES Act, signed into law on March 27th. One is the Special Inspector General for Pandemic Recovery. and that is a new Inspector General position recently appointed earlier in May. And that individual has subpoena power, has full authority to investigate fraud and abuse. Separate from that, the CARES Act established the Pandemic Response Accountability Committee, or the PRAC. And the PRAC serves as sort of an oversight and coordinating body amongst various inspectors general of different government agencies charged with helping to provide relief. So separate and apart from those two, of course, what the public is probably most aware of to date is my former employer, the U.S. Department of Justice, which has already initiated multiple prosecutions arising from Paycheck Protection Program fraud. The Attorney General of the United States, William Barr, has made very clear this is a top priority, issued a memo to U.S. attorneys' offices in March, making that priority clear. And so we can expect much, much more of this to come in the coming weeks, months, and years, I think.
And Justin, I want to kind of follow up on that a bit, and I'm going to bring Joe back in as well, whichever you wants to go first. But now, of course, we've set the tone here with Mr. Barr, but how aggressively do you really think the SBA and the federal government will audit these PPP loans and or enforce them? We've got from the top, we've got the expectations set. But do you think, for example, these enforcement agencies might allow for good faith efforts? We've got a moving target. We've got changing guidance coming out and updated guidance and whatnot. Will the lenders at least have an option or an opportunity to mitigate where they might unintentionally commit violations?
Sure. Joe, if you don't mind, maybe I'll take that first and then turn it over to you. I think that some of this is actually addressed, Brian, in the SBA's guidance to borrowers and lenders. And what I mean specifically is, given the enormous scope of this program, the SBA almost by necessity had to set a threshold for audits and the like. And so they established a $2 million threshold, meaning that if you acquired a paycheck protection loan in an amount of less than $2 million, the presumption is that your certification of need, because remember, all the borrowers had to certify that this was necessary, that there was a necessity for these loans. And so if you acquired a loan in an amount of less than $2 million, SBA has said, look, we are not going to go and audit all of those loans because the vast, vast majority of them are in an amount less than $2 million. Very few, relatively speaking, are above that threshold. And so what that means is you have an enormous amount of loans, both in terms of number, but also in terms of value, that are just not going to get that close scrutiny by the SBA. Now, that doesn't mean, of course, that people can willy-nilly get these loans and that there's not risk from oversight. There certainly is. DOJ is showing that, and in egregious cases, they're going to go after those people. But yes, there is a threshold, and if you have a loan in an amount of less than $2 million, it's almost presumed that your certification as to necessity was made in good faith. For those who are, got loans in an amount above $2 million, there's going to be a safe harbor for them if they're alerted to the fact that, well, maybe the necessity was not really there. They will have the opportunity, according to the SBA, to make a repayment of the loan proceeds that they received.
Joe, would you like to comment there?
Sure, I'll chime in just to note that the enforcement priorities against the borrower is certainly brazen fraud. If a borrower comes in and makes up employees, lies about where they're spending the money, how much their rent is, the government will come after them. They've already had prosecutions in that context. And, a mistake is understandable. The fraud is what the government's going to go after. So, those are those types of cases where it's quite clear. This isn't we had a question over how to count our part-time employees. It's we made up employees. Those are the borrowers that are getting prosecuted. As far as lenders go, when a borrower commits that type of fraud, the lending institution becomes a victim. We have a bank fraud statute for that reason. And the government, is going to be looking at the borrowers in that context. Where the lenders might face enforcement action is, certainly in discriminatory lending practices, in rampant and systemic failures of their compliance program. Not filing any SARs in really strong situations. For instance, if somebody takes out a paycheck protection program loan and for hundreds of thousands of dollars, and then the money sits in their account and they don't pay it to any employees or pay any expenses, there's other information that the bank has within its possession that strongly suggests that the money is being used for illegal activity. It doesn't matter where the money came from. It goes right back to the broader BSA AML program obligation. You have to have a risk-based compliance program. But there's absolutely good faith exceptions built into the existing law as well as into the PPP situation. Specifically, a number of government agencies have talked about the timelines. If somebody doesn't get their SAR filed exactly within the time frame on lower level activity because they're just crushed with everybody working around the clock to get this money out and process these applications, the government's not looking to enforce those types of minor compliance failures. They expect a risk-based program to be operated in good faith. You're looking at the highest dollar amounts. You're looking at the most potentially suspicious activity in filing SARs in that area. You're working the fraud angles. You're doing something to try to stay in compliance with the civil rights programs and efforts. So that's where good faith comes in on the side of the lenders. It's always been a risk-based, commercially reasonable expectation, and this is not something where the government's looking to go after people or indict companies or even work in the regulator side of things to tinker with licenses or bank examinations. They get that this is an extraordinary time. So good faith is built in. But if you don't have any compliance program at all, or there's rampant failures, that's never been considered good faith. And that's where the government would likely enforce.
Okay, so we'll really be going after the bad guys in this case. They're not looking for the nitpicky details, or at least it would appear so at this time. I want to go ahead and move now. I'm going to bring Alan back in, and we're going to speak to the business borrowers, the small business borrowers, talk a little bit about forgiveness. I know there's been a lot of discussion about that out there, and a lot of these borrowers are still a little hazy on what will or what won't be forgiven with the loan, and we've had more guidance in recent weeks as well. So, Alan, tell us a little bit about what the small business borrowers would need to know about forgiveness if they qualify and whatnot.
Yeah, I think the forgiveness part is probably one of the most refreshing part of the program for most business borrowers, because basically what it does is it allows a portion of the loan transaction to be turned into a grant as long as they follow certain protocols. The program originally rolled out that, for example, if somebody had a $100,000 loan, they could get up to 5% or $75,000 potentially forgiven based on payroll. And then they could have eligible uses of other things, but the loan amount itself was only based on payroll. So that $100,000 loan had to be eligible based on parameters and documentation that we did in order to justify the payroll. But then if the borrower didn't use it all for payroll, as long as they used 75%, they were golden. Now, what the government did was they lowered that bar from 75% down to 60%, which really helped out a lot of borrowers, because then if they wanted to use it for other eligible uses, such as mortgage interest expense on other loans, utilities, things like that, that other 40% could be used for that, and still 100% of the loan could technically be forgiven. The other thing that recently happened is the window or the look back for forgiveness was going to be 8 weeks of a time period, and the government expanded that to 24 weeks. And so in many ways, I kind of look at it as originally the borrowers and the lenders were going to be up against a sprint to be able to see how they were going to capture the use of proceeds eligibility-wise within an 8-week period of time. But now they're able to absorb that 24 weeks. So we're able to kind of take a breath and take our time and have the borrowers take their time and reach that first benchmark of how much they're going to use for payroll out of those use of proceeds. Again, focusing on a benchmark of 60%, and then trying to get to 100% by either with payroll or other eligible uses, so that they can get the entire loan basically paid back or granted. So the forgiveness piece is definitely a real plus in this program. And the recent changes that the government rolled out really does make it attainable, that the borrowers are going to be able to seek 100% forgiveness if they take their time and if they document.
And I want to bring Joe back in here for a moment here, as we're kind of moving from, for the most part, out of the disbursement phase, and we're going into either the forgiveness or repayment phase, although, again, as Alan pointed out, that's been extended now. But Joe, let's start with you, and then we can come back to Alan as well. What should the typical PPP lender be most concerned about as we start to look ahead to forgiveness or repayment, that sort of thing? Well, the money's out there for the most part. I know folks are still taking applications, but how should lenders be turning their operations now for the next phase?
Sure. The forgiveness program is naturally going to be a bit higher risk than traditional loans, in the sense that that becomes free money, and that's where there's going to be that criminal incentive to defraud. If there is going to be misconduct, it's going to be in this stage where somebody gets forgiveness inappropriately. So lenders have to be on the lookout to not become an accomplice to wire fraud, bank fraud, or anything else, whether it's through their own loans they put out or with other loans. For instance, if a borrower is working with the bank to get documentation in support of a forgiveness application, they may have 2, 3 banks or financial institutions assisting them. And a bank does need to be on the lookout to make sure that they are not assisting the borrower in creating a fraud scheme or otherwise defrauding the government by turning a blind eye to significant indicia of fraud. And that's something that will be considered. Another issue is early on in the program, many financial institutions made the decision to focus on their existing customers. There's a number of reasons for that, certainly all legitimate, in the sense that your existing customers are already known to you. It's faster to lend to them. They've already been through the Know Your Customer process. There's an incentive for the lender to support the businesses that might already have other loans with them to ensure that they don't go under. But now that's where those decisions, the early part of the process, come back to the lenders. They may have more information on these individuals, which heightens the compliance obligations. If the lender is also the depository institution for the employees of the company, they're going to have a lot of information about how the money is being spent, where that money is flowing from company accounts into employee accounts. And if they see suspicious activity, because they have all of that data in their possession, they are going to be obligated to file suspicious activity reports and not turn a blind eye or compartmentalize all of these different areas. So there's a good thing to knowing more about your customer and the employees of these small businesses and to seeing all of the activity coming in and out of their bank account. But that also does heighten your monitoring obligations. The more data that you have, the more difficult it is to say that you couldn't have detected suspicious activity when it jumps off the page from that transactional data, or even teller side, frontline associate interactions with customers, employees, business owners that give an indication, what they didn't really spend the money on, utilities, payroll. It was used for a marketing campaign, and they're trying to disguise it to get forgiveness or pull some other type of scheme. So that's where I think that's headed.
Well, thank you, Joe. And I want to kind of bring Alan back in again here and ask him the same question from the perspective of a lender who is distributing PPP loans. In your opinion right now, Alan, what should the lenders be most concerned about as we go from disbursement into repayment or forgiveness?
Yeah, I think really most lenders are just focused on making sure their borrowers are focused on documentation. Yeah, I think Joe brings up a really good point, making sure that things are consistent. So when we do the original application, the types of documentation that the borrower provided for the original application, if they provide different documentation when they're going to be seeking forgiveness, anybody that is analyzing that would probably want to, just maybe ask a little bit more questions why we aren't getting the same information that we got originally. But for the lenders out there, I think most lenders are pretty organized with respect to a checklist of what they're asking for from their borrowers, as far as payroll documentation, copies of bank statements, copies of utility statements, copies of your lease, things basically to evidence where the use of proceeds went and that they were eligible. And for each borrower out there, I would just encourage them to directly reach out to their bank or their credit union or financial institution and see if they have that list created yet. And some of the lenders are going to be using software applications, so there may be a link or a website that they can direct the borrowers to start gathering all the information. But kind of like I mentioned earlier, one of the things that we're telling everybody to do is, now that we do have 24 weeks, just take a deep breath, pause, relax, gather documentation, and make sure that you have enough documentation to support forgiveness of the entire loan. If you don't, there's no rush. Give it another couple of weeks, give it another couple months if you have to, because you have over 5 months now to gather up evidence for using those proceeds. So that's the only advice I think I would tell everybody right now is, don't rush it. Take your time. Let's get this right, because if you get it right, you're going to have a lot of forgiveness of the money.
Well, Alan, and you make a great point there in terms of documentation and take your time. I want to bring back Justin at this point, because at some point we're going to see greater scrutiny on the lender's decisions as to, whose applications to accept, who's getting funded, who's getting rejected. Justin, talk to us a little bit, if you would, about how that will be scrutinized at the federal level. Oh, Justin, you're muted.
Do you prefer me to be off of mute?
Outstanding.
So I think that there's some interesting evidence we're seeing already in the private sphere, just private civil lawsuits, that might give us a telltale sign of some of the interest that government regulators could have at some point further down the road. And what I'm referring to is at least 2 lawsuits that have been brought against big financial institutions, one in Maryland, one in California. The one in Maryland was brought against Bank of America by 2, interestingly, existing customers, depository customers, who said, listen, you did not give us funding. You've limited your funding sources to people who have a borrowing relationship with you and not just depository relationship. This is unfair. This is illegal. I think that we're likely to see, although the initial wave of prosecutions is focused on borrowers, would not surprise me at all that in time we see more scrutiny of lending decisions that have been made by banks, the basis for their decisions. Are they being fair and even-handed and non-discriminatory in the manner in which they are, dispersing funds? Same kind of situation in California with a suit that was brought against, I believe, Wells Fargo and JP Morgan, possibly others, where the claim of the plaintiffs is you funded the biggest of the small business applicants instead of us little guys. You prioritized the biggest loans that you could, and that was for reasons of profit, not for any other legitimate reason. Now, as Joe mentioned a moment ago, there could be any number of very well justified reasons for that. Credit risk, you may be concerned about your biggest borrowers, and you may want to attend to them first. You may want to take care of the fire closest to the barn, so to speak. But it will be really interesting to see how these kinds of private civil suits evolve and whether the government tags along with those and develops theories that lenders in some instances maybe have not used fair and appropriate protocols for determining who to lend to. And their management of the forgiveness applications as well.
Even though the SBA kind of gave lenders a little bit of protection under this program, basically saying that the burden of evidence and the burden of the loan request was primarily in the hands of the borrower. I think as a prudent lender, and I think most lenders basically did what I would characterize as just testing the waters with respect to the documentation that was provided and the eligibility of the application, because I think all lenders are focused on wanting to make sure that we're serving our clients and our members, but at the same time, at the end of the day, if that business does go out of business because of the events of the economy right now, how are we going to be able to go hat in hand to the SBA and say, oh, please, honor your guarantee on this loan? And I think all lenders are being prudent in basically testing out the documentation that's provided, testing out the eligibility parameters, and making sure that if we did have to go and have the SBA honor their guarantee, that we're fulfilling our responsibility as a lender to make sure that the T's were crossed and the I's were dotted. But I think ultimately, the program did require that the borrowers come to the table with the documentation and the eligibility and present everything to us. But some lenders have been pretty lenient on it, and some lenders are feeling that everything is pretty much at the feet of the borrowers to make sure they have it done. And I think some lenders, quite frankly, are a little bit overkill. I've heard of applicants that have gone back and forth between their lender 10 times to get their application processed. And so I think there's a happy medium to be served in making sure that we're all playing our part.
Well, Alan, it's interesting that you mentioned the back and forth. I think we can agree that there was and I'm going to throw this to both Alan and Joe, who'd ever like to jump in first, but we definitely saw quite a few different kinds of application forms, some different processes. In some cases, the same bank changed its own process midstream, especially when we go back to April and May in the first round of the PPP loans. So I'll ask both of you gentlemen, who's ultimately going to be responsible for the accuracy of the loan and or the forgiveness application eventually? Joe, do you want to jump on that one?
Sure. I think this goes back to the idea of the borrower will have ultimate responsibility for brazen fraud. If there is a criminal seeking these funds and they commit a fraud, they provide false documentation, they create a backstory that just couldn't be detected with good faith efforts. That is a criminal act by the borrower that the government will prosecute, and the lender's the victim in that case. It's bankrupt. In the civil context, when it comes to seeking recourse or who's going to get stuck with the bill for the loan if the borrower in good faith takes the money and then goes out of business, the SBA can sometimes be difficult and demanding in reviewing these applications. And I think there's been a strong sense that the government wants these lenders to lend freely and quickly. But if there's a major box that was left unchecked, that would be something that comes back to the lender. We told you to ask for A, B, and C. You didn't get C. You're out of luck. And that's probably the scary thing for lenders. But they do have a lot more time now with the extension. And I'll kick that to Alan because I think that's probably what's helping him sleep at night now.
Alan?
Yeah, I think Joe has it spot on. Yeah, I think the initial burden and the responsibility from a liability standpoint is definitely the borrower. The borrower is the individual or business that's kind of at risk from a fraud standpoint. But if the business goes under, kind of like to Justin's point earlier, talking about that the SBA isn't going to really go in and audit loans unless they're over $2 million in size because they don't have capacity to audit these, millions of loans. But I think they will be auditing loans that an SBA lender goes back to them for to honor their guarantee. So even if we have a $50,000 or $100,000 loan, if the borrower goes out of business and that borrower can't pay that loan back, and we have to go get a guarantee covered by the SBA is going to audit those files. And when they audit those files, that's where the burden is really on the lender, that we've done our proper due diligence in gathering our documentation or crossing our T's and I's and making sure that the eligibility is solid. And I keep telling my team every day, just make sure that file is bulletproof because we don't want any problems later on. And so it's hand in hand. There's responsibility for the borrower, responsibility for the lender, responsibility for the SBA to honor their word and hold the lenders harmless to an extent. But we're all in the game together and playing hard. So.
I was just curious, a lot of this was focused for small business. Small business typically, at least in my view is, 50 employees and less. But a lot of these, I would think, Alan, were very small operations of maybe 20 employees and less. How difficult has the documentation been trying to get it? And to piggyback off of that, Joe, if you're looking at an enforcement issue, or maybe you're having to represent a client in an enforcement issue, how difficult is that, is that process going to be or has been so far?
I think from my perspective, from a lender's perspective, the documentation on the larger applicants was actually easier because they were typically more organized. For the smaller applicants, and we did a lot of transactions that were less than $10,000, $20,000. So really tiny transactions. Our smallest transaction was actually $700. And that kind of brings up the point that, the lenders really didn't make money serving these customers and serving these members with these loans. We really did it for the focus on supporting the community, the business communities, and really the economy at large. But when we did do those transactions for the smaller borrowers, in some cases, the documentation was a little bit challenging. And if there's any area that SBA probably should have made things a little bit simpler, was working with individuals that are like sole proprietors or individuals that were taking disbursements from Schedule E, which quite frankly wasn't very well articulated in the procedures. So, there were ways that, we had to kind of be creative sometimes with the smaller borrowers, But I think at the end of the day, the program prevailed, and I think everything worked out fine.
And, I want to take this out to either Joe or Justin, if either of you want to comment. Are we in the theme I've heard from you in terms of expected enforcement has been, we're not going to be able to catch every mistake, every detail. We're not looking to catch anyone who has a little miscue here and there. Do you think the same general rule will apply with the smallest of businesses where documentation may be a little more difficult? Do you see that kind of carrying through, or at what level do you think the mom and pop shops again, how safe are these folks when it comes to, missing a document here or there, completely missing it? What's the concern there?
So just speaking for myself first, I think Joe's exactly right in saying that, the most egregious cases that really reflect criminal intent and clear-cut fraud, those are areas where U.S. attorneys' offices across the country are going to have a strong appetite to go over those folks. If we're talking about, some missing documents here or there, we're not giving legal advice here today, and we wouldn't say that that's a free pass, obviously, but I have a hard time believing, and I really welcome Joe's thoughts as well, whether the SBA, given everything they've done to triage, is going to get too exercised about a handful of missing documents from a sole proprietor. I just don't see that being a high priority. Having said that, of course, just as Alan is instructing his team to ensure the file is bulletproof, the guidance to borrowers across the board would be, pad that file as well as you possibly can, create a really good record of the good faith basis for your certification to necessity, and not only that, but how you're actually spending the dispersed funds so that you're able to improve your odds of reimbursement because they're qualifying eligible, mortgage, interest payments, rent, utilities, that kind of thing.
Yeah, you're probably make a great point there, Justin. It's probably not a good look for U.S. attorneys to be spending their time looking for cable bills from $500,000 businesses or whatnot. So that makes a lot of sense. I'm going to go ahead and move on now. Let's come back to forgiveness, and I'm going to start with Alan on this one. We've talked about taking our time and moving slowly, but Alan, how quickly should borrowers be moving to submit their forgiveness applications? We've got more time now, right? So how fast should we be moving?
Yeah, I think I would encourage borrowers to probably wait until at least after maybe, for example, July 4th weekend or the middle of July before they worry about submitting their applications, even if they believe they have everything fully documented to support 100% forgiveness. And the reason why I would say that is the program has evolved and has numerous changes that have taken place over the last several months. And already within the forgiveness vertical of the program, we've already seen some rather significant changes. Those changes may dovetail into more changes over the next coming weeks. And so having a borrower take a little bit of time, even though they think they are fully vetted and ready to roll and get their forgiveness, may actually wind up being a profitable move for them. And since the loan is basically only at a 1% interest rate, taking that little bit of extra time and making sure that you have 100% forgiveness and you're able to take advantage of any other improvements in the program might be wise. But I would say by the middle of July, if you do have a full package and you think you're ready to go, work with your lender, have them basically test your documentation. And once you're able to achieve 100% forgiveness, go ahead and submit it as soon as you can. Don't wait until December. But I wouldn't rush it. And when I say don't rush it, I wouldn't worry about submitting anything this month. Give it a little bit of patience, give it a little bit of time. And once you reach that 100% threshold with your documentation to get forgiveness, then that's probably a good time to go ahead and approach your lender.
Well, and Alan, to follow up on that, inevitably, no matter how much time they have and whatnot, there are going to be borrowers who still have some level of unforgiven balance. So for
Yes.
those folks who just can't get that 100% forgiveness, what kind of options are they going to have?
Well, there was an original option of a repayment for the remaining 18 months. So the time frame for repayment was basically spread out over 2 years, 24 months. So when a borrower takes out the loan, they have 6 months of no payments, and then they have 18 months followed up after that of principal and interest payments. The program has changed. It's one of the evolutions in the program where rather than going to 24 months, the lender and the borrower are able to opt to change loans that were done before June 1st all the way out to 5 years or 4.5 years of principal and interest. So let's say a borrower, for lack of a better word, abuses the program and uses $40,000 for marketing, which is not one of the eligible categories. That $40,000 would initially be spread out over either 18 months or over 4.5 years of principal and interest. The catch on it, though, for the lender is it's at 1% interest rate, which is a pretty sweet interest rate. So even though the borrower doesn't get it forgiven, the borrower is going to have a rather appealing interest rate to repay those eligible use of proceeds.
So now let me follow up on that. We've already gotten the very lenient, the change from 75 to 60%. Let's start with you on this one, Joe. We'll come back to Alan as well. Let's say I still don't manage, I'm a borrower and I don't get to 60% in eligible payroll. What happens then?
You are still eligible to have forgiveness. 60% of your forgiven amount has to be spent on payroll. And the laws and the regulations have been amended a few times on this, but Secretary Mnuchin himself has come out with a very clear statement saying that partial forgiveness is available and that the way to conceptualize it is 60% of whatever you get forgiven has to be on payroll. And then the rest, the other 40%, can be on the allowable expenses like utilities, rent. And then the remainder would go to that unallowable, not forgiven amount that goes into the plan that Alan spoke of, where you have several years now to pay it back.
Okay, that's a big difference. Alan, did you want to comment on that as well?
Yeah, no, Joe's explained that really flawlessly. Because basically all you're doing is you're compressing or shrinking the forgiveness based on how much was used as eligible payroll. And then you can overlap and dovetail that into to get to the extra 40%, and then whatever is not forgivable, we amortize that out. But the goal is extract as much time as you need out of this 24 weeks to add up your utilities, your payroll, and I would just encourage everybody to focus on that first benchmark, payroll. Once you get to 60% for payroll, and then see what else you have available to pull in on rent, utilities, and everything else to get you to 100% forgiveness.
Sure, and that seems in keeping with the intent of Congress in passing the laws. And Alan, let's stay with you here for a minute, but I am going to shift gears. See what I did there? Let's talk technology. Near and dear topic that's near and dear to our friend Rick Grant. Alan, so far in your experience, how often have PPP lenders, I know we talk about the mortgage industry quite a bit here, and technology usage can be mixed, shall we say, but in your experience, and you don't have to name names necessarily, but how well have the PPP lenders used technology in the application process, especially since that's where we've been for the most part, but even if you've seen it in other elements of the process as well?
Technology has definitely played a key role, but it's been an evolving role as well. The thing that's very unique about the PPP program is it is a completely brand new, from scratch, ground up program. And that's created challenges for all the lenders that maybe had flawless systems in place to handle a normal commercial loan. but they didn't have that same kind of system in place to be able to handle a PPP loan. Because a PPP loan, there's no guarantor, there's no collateral, and there's no cash flow analysis. So three of the benchmarks that a lender is typically going to look to analyze a loan are kind of out the window. And then there were other benchmarks and eligibility parameters that were baked into it that we've never had to deal with before. So a lot of lenders literally had their IT folks and their techs up all night for about 2 weeks to create a platform that they could roll it out with. For us, our organization basically did everything manually. We created our own, Microsoft Word, Excel templates in order to get the program launched. But we are taking advantage of a pretty slick program in order to do the forgiveness piece. So in order to get it done immediately and really serve our clients and members, we did it manually. Some of the larger credit organizations, Chase, et cetera, they were able to have the IT folks, get a program launched pretty quickly, and they were able to do it primarily software based. So it really depended upon the organization and how they're able to launch it. But thank God that the program was rather simplistic. So even doing it manually was something we were able to get off the ground in about 5 days.
So, and that's, you make an excellent point there, Alan. I hadn't even thought about that. It's not like there's a lot of out of the box PPP technology, cradle to grave type stuff, is considering the speed of the program. So, and is that, and again, I don't expect that you've seen every other lender's approach to the process, but being in the industry, is that kind of what you've seen around what you have seen out there, a mix of proprietary on the fly, kind of repurposing existing tech, and then good old-fashioned spreadsheets, pencils and pens, that kind of thing in some cases?
Absolutely. Yeah, that's especially when you're dealing with the smaller lenders that are less than 2 to 5 billion in size. The majority of those really just, got some really good, smart people on their teams to create what was needed. The larger organizations, they were able to pull together more sophisticated tools. But at the end of the day, all of those tools had to be able to be complemented with the SBA software, which is called eTran, and that's where we uploaded everything.
A lot of moving parts to this program, so it's admirable what's been done to this point. So, gentlemen, we've got time for one more question here, and it's a big one. It's open-ended on purpose, and the attorneys will understand that that's a critical tool in the toolkit. Open-ended questions, right? So it's still early in terms of the big picture, and the finish line is getting moved back constantly. So we're still in early days in some ways, but I want to ask you all, do you think the program will end up being counted as a success? And then if you want to follow on that, what could we have done better in the implementation, and what did we do well? And, Joe, do you want to start us off on that one?
Sure. The implementation part is always tough to judge because this is happening as history is unfolding. Once in a generation crisis, a mix of, the 1918 pandemic, the 2008 financial crisis, the, unique moment in history that we're at, again, Depression era issues being raised again with unemployment levels. So I don't think the rollout could have gone much smoother, but it was a rocky rollout. This was a case where law was being made in the public eye, on the fly. Negotiations were happening in real time. There was certainly a business-driven purpose out of Washington. And some of that, again, is just a sign of the times here, where we just have unique individuals leading and within the top levels of the administration. It was a business response rather than a political response, and it was unique. And certainly, I think there was a lot of interest in the program. There were a lot of questions unanswered. There were a lot of concerns as it launched on how do we do this. We all think it's a good idea, but we all have different ways to tweak the idea. And there was rapid movement within Washington to hear the comments, hear the concerns, formally and informally, push the rulemaking process quite fast. And now I think we're at a point where a lot of clarity has been achieved. And they've set the tone in Washington that if there are reasonable questions and concerns being raised, you'll get reasonable responses. They're never going to say, don't worry about compliance, don't worry about fraud, don't worry about civil rights and discrimination. They are going to say, we understand you're trying to put a lot of money out into the system very quickly, and this is a situation where you're also trying to do this while you're working from home, and everybody has their own family obligations, and you're dealing with people that are, again, they're worried about a public health crisis, not necessarily, faxing you a utility bill from 2 months ago. So I think that has very much been recognized throughout this process, and they've put out guidance and tried to answer the questions in the most reasonable fashion. And they really have listened to industry experts. Again, I mean, that's usually this happens behind the scenes. Somebody comes up with an idea, they put it together, they privately circulate it to legislative advisors and industry experts that rip the legislation apart and say why it wouldn't work, and then they redraft it and they go around in circles a few more times. And then it gets published and it's still disliked in a politicized, polarized climate. That initial vetting and stakeholder buy-in couldn't even occur in this type of setting because it unfolded so quickly. So given that, it was quite remarkable to see a program of this scale with this many unique features rolled out that quickly. And I think each day that goes by, the additional guidance has given borrowers and lenders additional security. And I do think the program will be considered a success. And certainly because it's probably the part of the CARES Act that was most widely known to Main Street individuals, other than perhaps maybe the stimulus check payments, which again, that had been an idea used back in 2008. But this was certainly a first in history type program to really get these grants pushed out through a commercial lending system.
I would agree, Joe. Hell of an undertaking in such a quick period of time. And, Microsoft is allowed to update their products after they roll them out. So I suppose it's only fair that we give the government a pass on that as well. Justin, how about you? How did we do with all this? Where could we have done a little better maybe? Or what did we do really well that we may not have anticipated?
Sure, Brian. I agree with Joe. My overarching impression is really positive. I think that the federal government deserves a heck of a lot of credit for being able to roll out a program of this size and scope in the incredibly short period of time that it did. There's plenty of constructive criticism to go around, without a doubt. We could always have used more guidance. Nobody's going to say we had enough guidance, right? Everybody always welcomes more. But I think by and large, I hope that history will show that this was just a remarkable effort in an incredibly short period of time. Let's not forget the sense of panic in March of this year when the entire universe seemed to shut down. And our federal government, to its great credit, was able to keep the ship afloat. And so, I think one has to give credit where it's due. There's some things that could have been done better, but it's a work in progress, and I think it's done pretty well so far.
Mr. Grant, mark the time. This might be the first time on Three Guys and an iPad we've been just about unanimous on the federal government doing something well. Alan, are we unanimous? Is the rollout a success, or will it be? And what could we have done better, if anything, or else what did we do that exemplar? What did we do that was just incredibly well done?
Yeah, I think Joe and Justin are, again, just spot on. We all are in the habit now of giving stars and up to 5 stars for different programs, and I would say the SBA at the end of the day is a solid 4 on this. They weren't perfect, but they certainly gave it their best shot, and ultimately I think strong conceptual minds did prevail. But at the end of the day, the entrepreneurs are really the heroes here. The entrepreneurs and the business owners, they were the ones that had the resilience, the tenacity and the creativity to hold it together. And I think the V shape that we're starting to see in the economy already, hats off to all the entrepreneurs and business owners out there, because they're the ones that are pulling it together.
Well said, Alan. Well said. Isn't it the backbone of the country usually that carries us through? So we're going to give an asterisk. Credit to the federal government with a big assist from small business and the American economy. So, well, gentlemen, that's all we have time for today. Wow, did we jam a lot of great information into an hour. I'd like to thank our special guests, Justin, Alan, and Joe. Gentlemen, and I'll come to each of you. We'll include contact information in the show notes. So let's start with you, Justin. If someone wants to reach out to you after the show, and by the way, please, folks, this is not free legal advice. This is general advice. So please don't go after Saul Ewing because they gave you some kind of legal opinion. That's cheating. That's not what we're doing here. Justin, if someone wants to reach out to you after the show, what's the best way to do that?
Brian, the best way to reach me, and I suspect Joe too, is through our firm website. You can just Google me, Justin Danilewitz. Go to Saul Ewing's website and feel free to look us up there. We'd be more than happy to chat with anybody about anything at any time.
And Joe, that's for you as well. Just hit the Saul Ewing website, and the easiest way to get to you?
Yep, I'm on the website, and my email address is joe.valenti@saul.com.
Outstanding. Alan, what's the best way for folks to reach out to you?
Same. Our website is phenomenal. Our team's done a great job with it. It's goamplify.com. And my email is real simple. It's ajules, no period or dash, @goamplify.com.
Fantastic. And of course, our good friend Rick is going to include all three of our special guests today. We're kind enough to submit a lot of good material, some PowerPoints, I believe. We've got some handouts, some supplemental information about the PPP loan, the ever-evolving PPP loan process. So please check out those handouts as well. They will be in the show notes. And as always, I thank the other two guys out of the three, Kevin and Rick. Thanks for joining us today, gentlemen. And Rick and Kevin know, and I'll introduce the rest of you to the fact that we record this show on a second-generation iPad, and right now it is smoking and down to 1%. So I thank you guys for joining us again. With that, Mr. Grant, take us home.